This is the first of a two-part presentation on understanding the story being told by your association's financial statements. In this first part, we will provide an overview of the financial statements for a community association to help a new board member or new association manager understand the story contained within the financial statements so they can understand where the association stands financially and what needs to be done, if anything, moving forward. As a board member or manager, you should receive on a monthly basis a financial package that contains a balance sheet showing the financial position of the association, an income statement versus monthly and year-to-date budget for the association, which shows how the income and spending for the month and period to date is going versus budget. Details of delinquent assessment receipts indicating how much and who has not paid their assessments. Bank reconciliations and bank statements. A check register and details of journal entries for the month, and highlights of financial issues arising from the financial statements. This video will help identify the key items in these financial statements which will allow you to understand the story of what is going on in your community from a financial point of view. This presentation is designed to be very general, and you should look at your particular state's regulations to ensure your association's financial statements are fully compliant. As we begin, it is important to understand how your association's financial statements are prepared. Most often, they are prepared on a cash basis, with the exception of the monthly assessment payments, which are recorded on a accrual basis. What does this mean? It means that expenses are only recorded when paid, so there may be, and most likely will be, expenses that have been incurred during the period covered by the accounts, which are not yet reflected in the accounts. On the other hand, assessments received are recorded assuming that they are all paid when due. This means they are accrued. This means you need to carefully review any assessments that have not been received, that is, the delinquencies, even though the financial statements assume that they have been. Hence, the need to carefully review the delinquency report. With this introduction, let's start looking at the key items in the financial statements which will tell the story. Firstly, the balance sheet. This part of the story is all about the financial position of the association. Key things to look at here include how much cash is there in the bank? Does this indicate we have enough cash to pay next month's expenses? As an estimate of how much next month's expenses will be, assume they are the same as the prior month. Is the cash on hand too concentrated in one bank? As a matter of principle, an association should not have more money in any one bank than the amount that is protected by FDIC insurance, currently $250,000. An association should avoid putting itself in a position of losing money because their bank fails and its deposit balance exceeded FDIC insurance limits. If the association has more operating cash than is needed for the next 2 months, thought should be given to investing the excess cash for a short period of time. Moving now to reserve funds. Are these invested reflecting the reserve fund expenditure needs of the association? Funds needed in the short term, 1 to 3 months, would probably be in a money market account. Funds not needed for 3 months or longer should be invested according to the investment policy of the association, with thought being given to 1. Can the association access the reserve monies in an emergency for unexpected repairs, i.e. those caused by a hurricane or a large storm not covered by insurance? And 2, is the money invested in a laddered fashion so as to reflect likely spending needs for these funds? Receivables. This is the money due to the association. and the majority of which is likely to reflect delinquent assessments. If this number is large as a percentage of total assessments, or if it is growing, it may indicate the association has a pending cash flow problem. The last thing I like to focus on is the liability of the association, and two things here are important. Are there accounts that are due to be paid which have not yet been paid? These will be a cash drain in the coming months, so you need to understand if there is enough money in the bank to pay them along with the regular monthly bills. Secondly, what is the size of the prepaid assessment balance in relation to total assessments? This represents assessments that have been paid to the association in advance of them being due, and the cash from this payments are already reflected in the bank balance. If the prepaid assessment balance is large, it could mean there will be a lower cash flow in the future months, and this could then indicate a cash flow problem for the association if the money has already been spent. From a review of these items, you should be able to understand the financial story for the association and its ability to keep operating from a cash flow point of view. Now moving to the income statement. The key question to ask in looking at the income statement is, how is the association operating in relation to its budget? Remember, of course, the budget is just that, a plan or estimated expenditure for the year. But it does provide the framework through which to evaluate income and expenses and help you understand if the association is operating as planned. Larger variances versus budget, especially for expenses, on both a month and year-to-date basis need to be understood. Are these because of higher operating costs than anticipated, or just a timing difference? Timing differences arise when the budget assumes spending will be spread evenly throughout the year, while actual spending occurs more irregularly. The commentary or highlights that should accompany the financial statements should give some explanation of variances. As the year progresses, there will be overs and unders versus budget, and hopefully they will balance out. If expenditure looks like being above budget for the year, and if income has not increased to offset the higher spending, this is a key issue that needs to be addressed sooner rather than later. Savings or adjustments will need to be made in other budget categories so overall the association can stay within its budget. With this review, you will understand the income and spending story of the association and whether the association remains on track with its budget and whether adjustments need to be made. Moving now to the delinquency report. This is a critical part of the financial story of the association. It should list all members of the association who are behind in paying their assessments. If this list is large and growing, it means the association is likely heading for cash flow problems and will either have to collect on the delinquencies or cut its spending. You will need to confirm that each delinquent member of the association has been communicated with in line with the rules of the association and your state's laws, and that appropriate collection procedures are in place. I recommend you work with a collections attorney who is conversant with association collection processes and state law to ensure the association has its position correctly protected. Understanding the delinquency story and taking timely action to collect what is due is important to the financial health of the association. Accompanying the financial statements, you should also review the bank statements and bank reconciliations. First, you should check that the bank statement balance is the same as what is recorded in the financial statements, or if not, what the reconciling items are. Then you should check that the bank balance has been positive all month. If the bank balance has been negative at any time during the month, it indicates that the association's cash flow may be insufficient or that the association's cash flow is not being managed adequately. On the bank reconciliations, you should look for deposit differences, i.e. deposits either recorded in the financial statements and not on the bank statements or vice versa. If these are dated right at the end of the month, it can reasonably be assumed it is just a timing difference. But if it predates month end by more than 5 days, it needs to be investigated. Likewise, any check that has been recorded in the financial statements and not yet recorded by the bank needs to be reviewed. Again, if these checks are dated more than a week prior to month end, an investigation needs to be done to make sure there are no issues. Lastly, a review of the check register will provide a good overview of who has been paid and how much. Things to check include multiple checks to one payer, checks made to individuals, and checks with an unusually large amount. These items do not necessarily mean there is an issue, but rather gives clarity on who has been paid and why. Likewise, journal entries made for the month should be reviewed to make sure they are understandable and correctly reflect what is going on in the association. Additional details should be sought from the person keeping the accounts if the reason for the journal entry is not clear. As you review who has been paid, it is a good opportunity to confirm that all services above a minimal amount are subject to competitive bidding. And if they have not been rebid in the recent past, thought should be given to doing so. Lastly, the highlights. These should provide information on key issues in the financial statements and should answer many of the questions that arise from your review of the financial statements. The highlights should also indicate items that need attention in the near future, such as a CD maturing needing reinvesting, the insurance needing renewal, or some item with delinquencies that needs attention from the board. With this review of the financial statements, you should have a pretty good picture of the story of the association's finances. The key is to understand things that look out of place and to use the story being told by the association's statements to make decisions moving forward and to manage and strengthen the association. The financial statements are a tool to make future decisions, not just an historic record. And again, it is important you understand the regulations for your associations in your particular states, so you are reviewing the financial statements with these in mind.